So why this video? Well, I've been seeing millions of videos about short-term investing in cryptocurrencies, or just finding the latest stock. And I wanted to make a video where we address how professionals do it, how the big companies are doing it. Most of the younger kids probably think that this is how their grandparents do it, but it's still the way. What needs to be done is that you need to look at the stocks that you're evaluating, and you need to pick the best stocks for your portfolio. But in order to do that, you have to look at all the stocks. And Warren Buffett famously said in an interview that you just start with the A's. So this is a short video of me just going through the A's, well, the first 5 stocks in the S&P 500, just to see what it's like to actually look at the stocks with fresh eyes, not knowing anything about them, and trying to determine if it's worth digging deeper. So let's start. Here's the list. Is the stock growing? 3M is not growing very much. Let's have a look. So revenue has been quite consistent, even a bit down lately. Down during COVID, and now it's up again. This is probably not something I would be interested in. I wonder why equity is so low compared to liabilities. Maybe they're trying to squeeze out a high return on equity by having a lot of borrowed money. Maybe. To me, it's not a sexy company. I'm not going to look at it any further. Move on. Already here with the price to earnings ratio of 18, I feel it's a bit too expensive for me, but let's have a look. So trailing 12 months of cash from operating activities, 591 million. Net income is going up steadily, which makes it interesting. 167 million in debt, 363 million in cash. Book value 12.50 per share, and it's now at 67. Almost 500 million in free cash flow over the last 12 months. The company is valued at 10 billion. Too expensive, unless I'm missing something. If we look at the cash flow statement, they're buying back shares. We like that. Retirement of debt, some. And what was the debt like? 166 million. And if we look at the income statement, they made 561 million over the last 12 months. So this would be an interesting company if they're growing fast enough. 1, 2, 3, 4, 5. 5 years ago, they were at 3.2 billion. Now they're at 3.9. So that's 700 million more, which would be, 20-something% up? Okay, could be interesting. Okay, it looked like an interesting company, but it's not growing fast enough. So I'm gonna move on. Laboratories doesn't sound like anything for me. I want simple companies that I can understand, or at least have a chance of understanding. Discover, development, manufacture, and sale of healthcare products. They do have quite a lot of debt to free cash flow, but not too much. They're increasing their dividends, also nice, but they pay out quite a lot of their net earnings. And that would be okay if the company has very solid financial statements, a lot of cash in the bank, but I'm not sure this company does. Total assets, 73 billion. billion. Total liabilities 34. Total debt, let's call it 16. 16. Net income 5.75 billion. I'm not thrilled, but I'm guessing it's okay for quite a lot of people to invest in a company like this. I'm going to pass. I don't know the industry. It has nothing that sticks out, nothing that I am really drawn to. Fourth company on the list, AbbVie Inc. The company has grown quite a lot over the last, how long is that? A couple of years. Even though earnings per share has not gone up. And we can tell here that the PE ratio has gone way up. It was as low as 18 and now it's at PE 60 something. Normally I would stop there. To double my money in 60 years is not something I'm interested in. If you have a really high PE, that would be okay if it's growing by, 2 digits at least. Rule of thumb is that you would like to, or you would expect the growth to be about half of the PE. So a PE of 15 would mean that you have a growth of maybe 7% per year. A PE of 30 might indicate that it's around 15. It differs quite a lot from company to company. Research-based biopharmaceutical company. That's a tongue twister for a Swede. This is a company I wouldn't touch, but let's have a look at it anyway. A high dividend, a extremely high PE ratio. It's a new company, and especially in a tough business like the pharmaceutical business, I wouldn't touch it. It did have an increase in sales during COVID, but now it's going down. Revenue looks like it's going nowhere. Earnings are going down. And debt to free cash flow is way too high. Net income 5 billion during the last 12 months. And they have 71 billion worth of debt. That's 14 times the money they have left when everything is done after the year. Moving on. Next one is Accenture. Okay. Share price is up. Can you say that it's up and stable? Nothing drastical is going on with the share price. PE 29. If it's then growing by around 15%, it might still be interesting, and it definitely looks like it is. Not 15%. Well, it's growing. Let's have a look. So it's a $200 billion company, small dividend, PE of 30, 8 billion worth of debt, net income of 7.3. Okay, so debt seems to be under control. It's a global professional services company. Corporate jargon, that means very little. Accenture is a global professional services company that helps the world's businesses, governments, and other organizations build their digital core, optimize their operations, accelerate revenue growth, and enhance citizen services, creating tangible value at speed and scale. And that means what? So some form of consultancy company. So that should probably mean high margins. 66 billion revenue. Decent gross profit. I would like the company to have better margins than this. Gross margin is okay. I don't have anything to compare it to right now, but they're making money. Operating expenses looks like they're okay, but then we do not have enough money for the shareholders, or not enough to make a big profit. So what is that? 66 billion, 7.6, 10%, with low debt and 9 billion in free cash flow, up 1.4 from 5 years ago. I would say it has growth, but not enough. Not enough to be super interesting. I think services industries or service companies will have it rough. It's really impossible to know which companies will succeed. And the proof is in the pudding. So the companies that are really good will probably take care of themselves first and utilize all the new AI models. But then I'm thinking that the large companies who need a consultancy firm will have their own AI experts and the same AI models as everyone else. So why would you pay someone to help you when you can just ask your AI to act as a consultant? Well, that's the last one for today. I'm going to finish my coffee and watch some TV.